Overtime. I'm your host, Chris Vecchio in New York, Elisa Bivex in San Francisco, Dylan Radigan's in Milan, here to take you through the rest of this hour. Futures market closes at 5 Eastern, 4 Central. If you're on the website, tastylive.com, the platform Tasty Trade, welcome. Thanks for tuning in. If you're on YouTube, thanks for joining the conversation. Tell us what you think of this action today. The pop higher overnight, thanks to NVIDIA being allowed to sell their top-of-the-line chips to China. Okay, I guess the export controls are over. Good news for semiconductors and tech stocks for a portion of the day. We run into the CPI report this morning at 8:30 a.m. Eastern, and while it appears that it's not as terrible as it looks, because sure, it's up, but not as up as people anticipated, the internals aren't great. The tariffs are showing up. If it weren't for a housing market price slowdown, you'd probably see more of the tariffs. And so there's two bad stories to tell. The market doesn't like it at all as the day goes on. Yields continue to spike. 30 years clear 5%. Stocks trade heavy. The Russell's crushed to the tune of 2%. Even Bitcoin's down 2.86%. Our sweet prince silver is off by a healthy 1.73%. It's not all bad news, though. Those playing for a dollar bounce are continuing to see it play out. The yen cracks on to new lows. The euro's below 117. The British pound trades below its 50-day moving average for the first time in 5 months. So things are happening here as we make our way through this Ides of July. That's not a thing. But we do cross the halfway mark of the month here with a little bit of a bump higher in volatility. Ilya, I think the report itself this morning is worth discussing, and I took the liberty of breaking it down on Futures Power Hour. But you mentioned the same thing I did, and we have not talked about this yet today, on air, off camera, anywhere. Core goods inflation. That's going bump in the night right now, and it's weighing heavy on the bond market.
That's right. So I'm going to have granular charting on this for macro money right after this show. So if what we're about to say needs a visual for you, and I think it does, I think it helps to kind of visualize what's going on, stick around. After this hour, I'll show you all of the charts on this. But the short story here is, obviously, most inflation is still locked in the service sector. Of course it is. The service sector is the biggest part of the overall economy. No surprise there. However, we have seen no meaningful goods inflation basically in 2 years. This is not that anymore. The biggest increase in contribution to the headline inflation figure came from the goods side. Now, the overall contribution was still small, only 0.13 percentage points out of the 2.7% headline, which came in exactly as expected, was accounted for by goods. So not huge. However, the change in contribution from May to June was 4 times bigger in goods than it was in services. Services increased. It's by far the biggest, sure. None of that's new. But momentum in price change, the inflationary thrust, it's in goods. And that's the part that's scary because, of course, that's exactly what the Fed was so afraid of. That the tariffs will eventually start to feed into goods inflation. And that their job then is to keep it from spilling over into overall inflation expectations, because were that to happen, it would become sticky. And so the markets react in a understandable way. They slash rate cut expectations for this year. We're down to 38 basis points. That's not even 2 cuts. That is now less dovish than the Fed's own outlook. Moreover, it is the least dovish since, drumroll, February 19th. There's the top in the S&P earlier in the year before that massive sell-off. This is the most hawkish that Fed policy expectations have been since right then. And the outlook for 2026 is now the most dovish since the contracts started to trade for those periods. So we have exactly the sort of thing that we would surmise here on the show for the past couple of weeks that the markets would be afraid of, that they want cuts and that the data is going to tell the Fed not to do them.
The data may be telling us that already, if that's what you read through in the inflation data today. And certainly you look at the breakdown, and were it not for about a third of the U.S. housing market in a bit of trouble right now, seeing year-over-year price declines, then you'd probably have a stickier inflation report to the upside.
Mm-hmm.
But Dylan, if it's the tariff side of the problem, the news from last night, to me, should be as informative as anything. China, our great geopolitical adversary and rival, the country whose economy is eating the world and going to flood all of our Western developed countries with their cheap goods that kill our jobs. We're going to give them more of our advanced AI chips. NVIDIA, AMD are going to be selling overseas once more to China. But we're going to be tariffing the EU at 30%, Canada at 35%. What's going on? Is this just all kabuki theater, Mr. Radigan?
Caught up on this, Vecchio? How many times? Here's the thing, okay? The same way that the oil trade, when there's a World War III happens and oil spikes, you sell it. When Trump tariffs get all cocked up like they are, then you buy them. The tariffs are not going to happen. This is a buying opportunity. The only reason I'm not here jumping up and down is because my boy Ilya is here and I don't want to hurt his feelings. And he might
actually agree with you on the tariffs.
Well, on the tariffs, I'm sure you do. So let's talk about this because I think we probably
actually agree with you completely on the tariffs.
So you buy the tariffs.
I told Vecchio as much over text last night. It's like that scene in Die Hard 3 where all of a sudden Bruce Willis stops and goes, "Wait a minute, it's a heist."
But so here's my question for you, Ilya. Whenever there's a tariff super scare, you buy them. Okay, fine. Just like when there's an oil super scare, you sell them. But we did get this data today, which does show that there's that's not nothing, in my opinion. Like
that's real.
That CPI data to me was not nothing. I would like to say it was nothing, but I don't believe I could say it's nothing because I think it's something.
That's real.
And so the reason I'm not just like, buy them on the tariff madness is because, well, you might buy them on the tariff madness and you'll be right on the tariff madness, but I can't help you out on the inflation / delayed rate cuts / slower economy. And I don't really know how to reconcile how much of the sell-off is tariff madness, which is just a temporary moment of madness, and how much of the sell-off is legitimate concern about higher costs, higher inflation, slower growth, and later rate cuts. And I don't know how to reconcile those two things. So I
think we should have a sense, and obviously this whole thing is a moving target, but I think when last week there was a bunch of tariff announcements and the only thing that seemed to care was copper because the announcements spoke to it directly, but it didn't spill out elsewhere. I think that told you the markets are over the noise of this thing. What they want isn't the circus. What they want is economic data saying the stuff is real. And the problem with the CPI data is it suggests that, it is. And so the question, I think, goes back to, by the way, it's poetry in motion, really. That the Fed calculus for this year is back to mid-February, late February. Because what were we concerned about then? It wasn't tariffs conceptually. The time to be concerned about that was November. It didn't happen. The markets didn't care. We've said this a gazillion times. They were concerned about growth. They were concerned about real economic outcomes because business and consumer confidence surveys started to tell you we are in freak-out mode over this tariff rollout. Holy moly, this is going to be bad for growth. And then the hard data was delayed, and the Fed kept coming out and going, we know it's going to be delayed. It's always delayed. And the White House keeps delaying the tariffs themselves to some extent. This takes time. The economy absorbs things over months, not days or weeks. So we have to be careful. We have to wait and wait and wait. Well, they're showing themselves to have been somewhat accurate. It's early days yet. It's one piece of data. But so far, it's looking like the freak out in the PMIs and the ISMs and at the Fed got its first big chunk of evidence today. It started, by the way, already in the PPI data going back to March, April. But this is a big headline thing. And it's not about, oh, the tariff circus is this or that. It's about, here's the growth implication.
So I guess, okay, great. I agree. And when it comes to an investing thing, whether it's indexes, commodities, all the things that we talk about, is it even possible to, with any granularity, to differentiate one from the other? Or do you think that basically you're like, listen, if I'm Ilya, I know I'm right, because tariffs are not, even if the tariffs are going to end up being, what we all know, 5-10% reciprocal, sort of kick the can, kind of basic, some sort of moderate, whatever thing.
Sure.
But the reality is it is not going to create, it is creating inflation.
Yes.
Fact. It is delaying rate cuts, or it is likely to delay rate cuts, highly likely, fact. And it is slowing growth.
Yes.
And the markets are at or near all-time highs.
And are telling you today that now that they have hard evidence that all of these things are occurring, they don't like it.
And so if you were to put on, if you were me, and you had nothing, I'm long the dollar, I've been in and out of oil, I haven't done anything with stocks for months because I always fuck it up, excuse my language. Sorry, Chris, I'm sorry. I didn't mean that. It slipped out. Call your mom, tell her I'll get me a
hide your kids, hide your wife.
I'm sorry. I'm really sorry. And so, but if you were going, I'm sorry. I apologize. But it's true. That's what happens when I get involved with stocks. That happens. I up it up. Okay. Anyway, so if I was to originate a new short thesis today,
yes,
based on this information, because obviously there's a little sell-off today, but this is nothing, and I want to sort of get into a 45 to 60 day arc.
Mm-hmm.
Because there's going to be more inflation, there's going to be more slowdown, there's going to be, even if the earnings are good, there's going to be some cautionary guidance and all the jazz, and the rate cuts are not going to happen. Where do you put your best? I give you $5, you get 5 positions, $1 each. What are your 5 best new positions? Or 3? I don't corner you, but
so vol is incredibly cheap still. IV ranks in the stock indexes is incredibly cheap. So put verticals there are still very cheap. NASDAQ, S&P, Russell, I have all 3 on at this point. I think the dollar keeps going higher, and probably the place to really look at that is the yen. It broke a big range today. The euro didn't quite break its range. The pound didn't quite break its range. The yen looks like it did. So that's one. And then the other thing I would be looking at very closely is gold, which is down a little bit today with the higher yields and the higher dollar, but it is not running away anywhere. And that is a sign of impressive strength. Like, this is an environment where gold should look terrible, and it does not.
Yeah, silver looks terrible comparatively. It's not weathering
because
the storm.
it's got that risk on sheen on it as compared to gold. Gold today looks like the Incredible Hulk got bashed with a 2x4. The 2x4 broke and caused no damage.
That's comic accurate. I'll allow it. When we look at what's happening in the metals market, specifically in
I am nothing
silver,
if not comic book accurate.
we do see a pullback to basically the 1 week moving average today. That comes in at 38.02 in the SIU 5 contract, but our close is 38.04 or so right now. So there's still a hold there. We touched above 40 in yesterday's session in the end of year SIZ5 contract before reversing. Dollar up, yields up, a little bit of growth negativity as well. We can't dismiss the fact that this is all interrelated. So it comes back in. Gold's holding its ground despite a little bit of weakness there. And then we see Bitcoin likewise, which was a high flyer. A little bit of disappointment perhaps today being front run. There's some legislation up on the Hill right now related to stablecoin, digital coin, anti-CBDC legislation. And one of those votes just failed in the House. Now, Polymarket says there's still a 93% chance that the bill's going to pass by the end of this year. So if this is a...
Appropriately, they dropped the DOJ investigation against Polymarket today.
What are the odds? I wish we could bet on that one. I would have taken the other on it. I would have taken that trade, given everything we've seen. So it's, you could see though, there was this kind of like period of reckoning around the data release this morning, Dylan, where, you look at how the market responded initially. It's like, oh yeah, inflation's good. We're good. Oh wait, that's the wrong report. That's NVIDIA. Great. Okay, here's our inflation. Okay, yeah, we're fine. It's not as bad as we thought. Wait a second. Let's look through it. We're looking through it. Oh God. Okay.
And then you know what they said? You know what they said around there? They said, oh.
Yeah. And Trump said that Powell is too late, of course, and that we need lower rates right now.
How do you lower rates when the cost of everything is going up as a government policy?
4-month high, by the way, on the inflation rate, both core and headline. So we've transitioned into ergonomics apparently over there at 1600 Pennsylvania Avenue.
And you know
I'm
what's so
going
interesting?
to Turkey, I think next week. I'll check in on the whole situation.
See what they think about this. They have a level of expertise in nonsensical monetary policy that's second to none, really.
Do a little man on the street. Chris is trying to do his job. I'm sorry.
No, I'm really not. I'm trying to get banned from Turkey, and so I'm thinking if there's a way.
We might be already, man.
Don't do it on my dime. I'm going next week. I like it, Turkey. These are my people. Leave me out of this.
I'm just saying, if like a Radigan is arrested in a bazaar,
I'm gonna be on.
But I take credit for that.
I'm gonna be in Turk Buku, baby. You're gonna find me in the sliver.
Yeah.
You're gonna find me in a perfectly fine situation. Don't.
Yeah. For the record, I have said nothing disparaging about the Turkish lira in a long, long time.
Anyway, you were going to say, sir.
It's fascinating when we look at some of the mechanical methods of setting Fed policy right now. One such way is the Taylor rule, which is taking a look at what would the Fed funds rate be, assuming growth and inflation and unemployment rate statistics, and you assume certain run rates of growth, right? So you figure out growth gaps, you figure out the employment gap, the output gap. And right now, given where things stand, from a variety of metrics, the Fed funds rate should probably be higher at the same level, right? White is around the same level. Green means the rate needs to be up. Red means we could use cuts. Most of these are white or green. So you guys talk about a Fed that's losing the ability to justify cutting rates down the line for the reason that they've stated the tariffs, but for the tariffs, they would have cut already.
Yeah.
That probably gained some credibility here today, which is why on the other side of this inflation data, this is the key metric here. We go over to our CME Fed Watch tool. On the other side of an inflation report where the headlines were in line or just below the expectations, Fed cut odds went down for the month of July. They went down for the month. Yeah, so 4% there. But for the month of September, we lost, we'll call it 6.5% net in one day.
Yeah.
So let's, we look the hold from 37.4 up to 44.1, 6.7%. This is not the data that you want to see if you're Trump. And that actually, Ilya, speaks to the whole possibility where we have expiration tomorrow. Maybe the market bounces back a little bit. But on the other side of this week, when you get into your seasonal peak, the market tends to peak, close on the 17th, the 18th, it starts to go down. You get another minor swing higher at the end of July, perhaps into a new local high for August. But then the market really starts to suffer. Volatility seasonally basically moves up from here through, which is the second of the two Jewish holidays, Ilya, Yom Kippur or Rosh Hashanah?
Yom Kippur, that's right.
Yom Kippur. Okay, I just Gentile. Okay, so it basically rises from now through Yom Kippur.
No excuse.
I've watched
Don't
enough
worry,
Krug
we
and
are
Seinfeld.
here among you to clarify.
I should know, Dylan, right?
And you're a New Yorker.
guy.
New Yorkers are better. Being a New Yorker is more Jewish than being a Jew.
There are many such cases. In any event, you have this seasonal window where through that second holiday, from the third week of July through the second week of October, volatility tends to poke up. So I'm still, after all of this today, I'm feeling a little bit better about my longer dated view, Ilya, where it's like this week I'm riding the rails higher in the NASDAQ with calls that expire next week. That still made some decent money today, all things considered. But I have started to layer in those puts. And those puts to me feel a little bit more comfortable today, because if we go into a window where the Fed doesn't cut in July and is telling us that they can't cut because of tariff reasons, we have a pipeline of data coming now that's likely going to show some increased tariff related inputs. And look no further than what happened with food. Coffee was up coffee is being tariffed. We do not have the climate to grow it here. Coffee was up 2.2% month over month. Citrus, oranges, limes, lemons, grapefruits. There's like
we tariffed tomatoes from Mexico today.
Well, forget that today. We could see the citrus category in the food imports up over 2% month over month. We're just making things more expensive.
Were people about eggs? So how angry are they going to be about coffee, oranges, and now tomatoes?
Tomato sauce? Dylan, that sounds like anti-Italian discrimination.
It's a direct assault, frankly.
This, where I come from, they call this stupid.
What do you think the people in like Portofino are thinking right now? They're like, oh, my lemons are more expensive. I can't have my tomatoes. Like, who is this guy?
I'll tell you right now, in Portofino, they're not thinking about us.
No, they're not. I wouldn't be either.
This does not occur to them. They're like, will it be lobster or steak on the boat tonight? They're like, I hope the prosecco is properly chilled. That's kind of where they're at. They're not really.
Can I tell you what Portofino did for my flavor, my palate?
I can't.
That was the first place.
Yeah, please.
First place in the world where when I order a bottle of wine, I got Lay's potato chips as the side.
Well, no, aperitivo, you get it. That happens all the time.
Lay's potato chips and white wine is just an unbelievable combination.
But that, by the way, the aperitivo tradition, that, by the way, is the snack before dinner. Fantastic. We need to adopt it universally immediately.
I live in Italy,
How San Francisco hipsters haven't figured this out yet, I don't know. But I need to call all of my folks immediately.
And it's the best, like, low stakes social structure, because it's like it's not let's go out to dinner and blah blah blah, and it's not lunch or it's I'll catch you this afternoon for a drink and a chip. We'll have a chat. We'll catch you around. It's like it's designed for a social structure. But anyway, this is not the time or the place to evaluate the merits or lack thereof of the Italian social structure versus the rest of the world, because it's already been demonstrated vastly superior in every category.
All right. So we have our problem with bonds today. It's spilling over into gold, but it is, Ilya, we were touching on the currencies here. Dylan, Ilya, we're all on the same page with this, that the dollar looks like it's due for a bounce. I can't help but notice, Ilya, the problem that we were ascribing to the U.S. dollar in April. We're seeing higher interest rates, the currency's losing ground. That's not how it's supposed to work. That's typically the sign of a crisis. It's sovereign risk being repriced or something else, one or the other. Right. In the UK, in Germany, in Japan, interest rates are going up. All of their currencies are going down. The dollar has interest rates going up too, but the dollar isn't the one suffering on the other end of this. Mm-hmm. The dollar's behaving in a very normal fashion. Yes. And it's behaving a bit of like a safe haven, people need to get their hands on some U.S. dollars kind of situation.
I mean, the dollar also really took it in the beak. I mean, because it all happens in context here.
That's right. Yeah, it did. It was the worst start to the year ever. Right? Dollars unpegged in 1971, August 15th, 1971. Nixon takes us off the gold standard. When the Smithsonian arrangement expires in 1973, basically everything else goes free float. And
Right.
so since 1973, we haven't seen a start to the year like this.
Yeah. 73 is basically the genesis of the financial system as we know it now.
Right. So, but you now have your turn here in the euro. You lose 117. You have your yen breaking through 0068. Hopefully, some people held on for that ride with me. The Canadian dollars,
man.
Canadian dollars almost
I'm with
breaking
it.
down. British pounds below its 50-day for the first time since mid-February, and so that brings us back to DXY, where
Yeah.
among the euro, the pound, the yen, that's 80-something% of the dollar index. This is a test of the 50-day here.
Yeah. It's a
Are we-
meaningful turn.
This is 1, 2, 3, 4, 5 times, 4, 5 times now that we've been back to the 50 since we crossed below it.
And we
Is
take
this-
out former support, become resistance. I mean, obviously, you don't want to do technicals too granularly on the dollar index. It's a basket. It's a little fuzzy. It's not real market
not trading
action
it.
per se. But you were in a range. You broke out of the range. You're back in that range. So whatever breakdown we were looking at in late June, it's a failed one now.
Do you think this is the bottom? Is the 50-day
Yes.
moving average the final boss, basically?
For now, I mean, I don't think that the sell-off in the dollar in the first 6 months of the year was a flimsy or a trivial thing. I think it speaks to the rise in term premium, that is general uncertainty and duration risk for U.S. assets. And there's this chart here from Morgan Stanley. Good for them to finally get on board. I've charted this a little bit differently over the recent months, but I've just been showing two curves, one showing the share of the break-even rate in the 10-year against the share of the term premium in the 10-year. And the break-even rate hasn't gone anywhere but down trend-wise, and the term premium has gone nowhere but up trend-wise as a share of nominal 10-year yields. We just showed it most recently on Macro Money yesterday. We'll show it again today. So this is a story of increased uncertainty. But to your point, what it's not is a story of credible sovereign risk. Because what happened in the first 6 months of the year is yields went down across the curve. They didn't go down a lot, but they went down across the curve. There was no shortage of appetite for U.S. sovereign debt. Nobody is out there saying that this is a credible, oh my God, the U.S. will default type of story. And of course it's not. That was always crazy. So when we look at what this is, it's sort of what I've been talking about for basically now 2-3 weeks. This idea that in the second half of the year, the market has switched gears. If the first half of the year was about, this is a growth scare, oh my God, it's a sovereign scare, oh my God, the U.S. is going to cut off its own nose despite its face. No, wait, no, it's not. Okay, deep inhale, deep exhale. What is it? Oh, it's a growth scare. And we're back to just what's growth going to do, and when's the Fed going to start handing out the Kevlar vests? And with data like this, with term premium rising, you have a difficult issue, because on the one hand, the markets are saying there's more uncertainty, give us the cheap money to paper over it, and the Fed is saying, nah.
I find it really interesting that, maybe that's what the exercise was in April and May, where the market was pricing this additional term premium. The chart I was showing deserves some explanation here.
I think so.
The gold line that you see, or brown, I don't know what colors people see these days, blue dress, black dress. Here you have a line that's a little bit lighter, and that looks at the relationship, just an OLS. Where was the Fed funds rate implied by the market versus the 10-year yield on a given close all days, April 2nd, 2024 to April 2nd, 2025. And then looking at that same relationship from the closes from April 3rd forward. And there is still that linear relationship, right? But the difference is, compared to where the market is trading on the implied Fed funds rate and where yields are operating, there seems to be a 40 basis point gap now, given the relationship we've seen play out over the past year. And that's to suggest there's an additional layer of risk that's been built in since what happened on the afternoon of April 2nd after the market close? Oh, yeah, we got that phone board day from Donald Trump in the Rose Garden. And so April 3rd onwards, the market has applied a new price for US dollar denominated assets. And if we've already done that exercise here now, we're back to a normal world. The term premium, can it inflate more? Maybe. Will it? Perhaps not. But if it's not, and we're in a world where people are looking for liquidity right now, and they're trying to, well, maybe these tariffs are real. What are the big trades on the board? Long stocks, pretty crowded. Short dollar, pretty crowded. And their volatility is pretty low here. So, Ilya, the currencies seem to be a little bit more appealing if we're looking for a bit of a reversion. These are a lot more crowded trades right now based on the positioning data that we can see. The yen, the pound, the euro, a lot more crowded on a relative basis than the NASDAQ or the S&P. So if we're going to get a big reversion, I really like playing it through the currency space right now, which is perfect because that's your and my bread and butter, how we came up.
Oh, yeah. This is what we know.
But this is a really interesting case because now you're seeing other currencies like early April, higher yields, bad for the dollar, sovereign risk. Okay, well, in Japan, yields are shooting up across the curve. They're doing so in Britain. In Britain, you have negative growth. They're continuing to increase taxes. No one can figure out why the economy's stalling. It's Brexit. And in Japan, they have a rice crisis. Rice prices are through the roof. But because of the cultural significance there, the government's not going to import rice. They're trying to incentivize production nationally. There's an election coming up right now in Japan. And so the political party can't say, yeah, we're going to flood the market with foreign rice and potentially push out Japanese producers. No. So can the BOJ do anything except watch Japanese real rates erode in the short term? I guess not.
And so now kind of said as much.
And so Japanese nominal rates, their JGB yields, they keep going up. The yen keeps getting weaker. And the dollar is now, despite its warts and all, where did all of this bring you guys? Right back to May, to the king dollar. I think, because Dylan, I think it's time.
It's classic. I mean, what did we see in 2008? The mortgage crisis was in the U.S. When everything hit the fan, where did capital go? The dollar. Why? Just unrivaled liquidity. And so as long as you don't have the sovereign spook, which was ridiculous because no borrower is more eligible than the U.S. no matter what's going on in the current environment, capital went to safety here. It went to liquidity. It cashed out into the most liquid thing. Sorry, Dylan, go ahead.
No. I mean, I think the only question is what's the most capital efficient way to be long the dollar? Full stop.
Highest bang for your buck in the IVR world is going to be in your Canadian dollar. And we're probably at a potential turning point right now in that regard. It's a place where I'm not having any exposure at present time, but I see these former highs that we have here in April.
Yeah, I'm watching
post-Liberation Day. We have our 50-day moving average here. We could do it through the typical tasty methodology, selling a call spread up here, risking 4 to make 1. We could go a little bit more cowboy out here and buy an out-of-the-money put spread. Out-of-the-money put spread would be risking a little over 5 to make, risking 1 to make a little over 5, 15% probability of profit. Obviously, when volatility is this high, it's prudent to maybe think about taking advantage of that. But the Canadian dollar with its 73.2 IVR, we talk about diversifying strategies, time assumptions, expressions of the same view. Perhaps the best way to do this would be, look, we have our short call spread in the Canadian dollar to harvest the vol, and then we go over to our yen, which is still exceptionally crowded, and we go out to, say, 85 days and look at the long 65, 66, rather long 66, short 65 put spread, and there's your 25% probability of profit, a 4-to-1 reward to risk. And so you kind of have it bracketed there. You're playing the dollar on both ends. One of them needs the dollar to really get going. That's the yen side of the trade. The other is just about the Canadian dollar not rallying. And so you have a dollar bullish expression there. Two different cloths. One's a little bit more risk averse. One's a little bit more leaning into it. I'm going to be doing both. I feel good about the dollar now.
Okay.
Because it's getting so hated. I already have my long yen put spreads on. I'm going to start rolling those down tomorrow.
Mm-hmm.
I think that fact that we find ourselves at this 50-day moving average in the dollar gives us a reason to pause. But if we were to flush through this cleanly, Ilya, we have not seen a close on the other side of it since February 12th.
Yeah. I mean, I've been long the dollar for about 2.5 weeks now. As you know, I started laying it on with the British pound. That was the one that broke first. I've since put it on in the euro. I've put it on in the yen. I've put it on in the Aussie. So it's starting to happen. I think it's got some more legs to keep going. There was a point today when it looked like the euro might get held up. It's basically at support now, which is a really interesting thing. So is the pound. So we might get a little bit of a reaction off these levels to give better entry points. The euro could bounce a little here, in which case I'd be looking for that as a selling opportunity. The pound, the same thing. The yen seems like it's broken, and that's a big deal because with the yen you don't get a lot of mulligans. Other currencies vacillate around levels sometimes before they have the real move, so they'll kind of poke through a level and then hang out a second to digest. When the yen runs, it runs. And so this could be big there. The Canadian dollar is interesting. It hasn't confirmed it yet. The Aussie is starting to confirm it with this move today. So possibly a significant double top now in the Aussie. So that's an interesting one. I think now with basically no Fed action in July a given and September watered down, there's a lot of runway here because there's no Fed meeting in August. There's a bunch more data that's coming. If this data is emblematic of the start of a thing, as it looks, we're going to get a bunch more numbers that are going to make this look more dollar positive. And of course, if stocks are going to break, then, and we certainly got some steps in that direction on this, I wouldn't say it's confirmed, but it's certainly starting to look very spooky. If stocks are going to break and the dollar is going to be the classic haven that it is in times like that, it's going to rip.
Yeah, one thing that we've seen so far in the earnings reports has been the fact that the weak dollar in Q2 did help some of these companies with multinational exposure juice their profits a little bit. And so a world of higher interest rates coupled with a dollar that's moving on up, probably not going to be good.
Coupled with a little inflation action on the side just for a friend.
That's that tough skiing environment that the Russell ran into in 2022, where those companies have smaller moats, right? They can't really survive.
Maybe we should just back up the truck and go full madman on the Russell. You ever think about that, sir?
You know, the Russell's the Russell's at this spot where if you're not already short to give the Ilya of it all, right? You know, if you're not already long at the high, then what's the risk to reward? But we've already pulled back now into the 1 month today, the uptrend off of the April and June low. And then when I go to the 4-hour time frame,
you got to take out 2,200 essentially.
I have a head and shoulders pattern forming up here, which is a left shoulder, head, right shoulder. And in fact, I want to go to the 8-hour. There's a few things here that make why this is so interesting as a potential place. So shooting star for your left shoulder, evening star candlestick cluster for your head, and then bearish engulfing bar here for your right shoulder.
It's like textbook.
It looks good. And the right shoulder is below the left shoulder, which is necessary. So we're at that neckline right now, not yet broken because we haven't cleared. I have it marked off as 2210.3.
Yeah, so that's swing high. That's spike high right there. Yep.
This is the best place to buy.
You and I are looking at exactly the same thing.
I mean, but the trade here, Dylan, isn't to get short the Russell here. The trade for tomorrow is to buy the Russell here with like a 10 or 15 point stop. And if you hold this, then you're buying at trend support going back for the last 3 months. And that's what you should be doing in an uptrend. You should be buying at trend support. Here's the quip, though. If this
unless what you did was you sold it on the bounce into the formation of the left shoulder, which is what I did.
Well, this is the other side of this. Everything that's been happening. What if this is a big bearish rising wedge that's been forming, and the trigger formation?
That's how I'm looking at it.
The trigger here is going to be this head and shoulders. So like tomorrow, I'm looking for a bounce in stocks. S&P is near the downside of its range. Russell's at the bottom side of its uptrend. But if they don't bounce tomorrow, look, the July
PPI tomorrow.
Tomorrow's the 16th.
Which suddenly matters in recent months because that's where the math on how much margin producers are giving up to insulate consumers from tariffs has been showing up.
So we'll see it in there.
We'll see it
tomorrow's the 16th. If the seasonal peak for the month is the 17th, and then you just chop around with maybe a pop in the 30th or the 31st, like why fight those tides? I'm not going to fight those tides. I will take any equity longs off the table and sit with those longer dated S&P 500 puts and just coast for the next few weeks. And if I'm wrong, I lose a little bit of money being a bear. And I learned the very important lesson that being a bear is a stupid thing to do. No takers, no bait.
Sometimes until it isn't.
A long time ago. I mean, that's
sometimes until it isn't.
I sit in awe of Ilya because of he's got his micro short strategy. He's always in there getting kicked in the teeth, but it's only a small kick every time. And then when
just a little chip,
he's just
a little chip off the old canine.
He always has a slightly bruised nose at all times, but he never takes a full head injury. And then he's right in the room when it goes the other way, and he can step right into the whoosh. But God help you.
This has been kind of the thing with between the dollar and stocks in the first 6 months of the year. The dollar sell-off flattered the stock market by a lot. It also flattered my performance because for all the little dings I took on stocks, the dollar ran down, and it ran down way more than stocks rallied.
Yeah, for sure.
And so it's just, you never know with macro. The timing in macro is the hardest part of all.
Timing in everything is the hardest.
Say it loud, say it proud. The timing is very hard.
It's incredibly hard.
Which is
so
why
all you got to do is just manage risk.
The only way you manage time is with position size.
That's right. Position size and trade structure and leverage management, because you're not going to know. So when you get a spot that looks risk reward appealing, you take a very modest shot so that you don't get killed. But worst case, you catch a little bit of a black and blue situation on the ribs. It's temporary. You'll be okay. And just wait.
It's funny when you say like the risk to reward, because if the stock market compounds at 8% and I'm not retiring for 30 or 40 years, it feels like getting long stocks at any given moment in time has pretty good upside convexity, risk to reward.
On that kind of a time frame, I totally agree with you. And I have a separate portfolio for things that do that.
Ilya's secretly a real bull. Like 95% of his portfolio is allocated bullish and
bull. Totally.
He only talks about the 5% that he leans on bearish with. Dylan,
totally. I am incredibly optimistic about U.S. growth, the U.S. economy, the ongoing next American century of economic prosperity and dominance. Totally on board with all of that. That's just not a 45 DTE cycle idea. That's a 10-year idea, 20-year idea, 30-year idea.
Netflix, Apple, some of these big names, Amazon, Dylan, they haven't really been doing much of anything. Amazon actually does close marginally higher here today. Taking a poke over to the retail stocks, those not having fun. Leader to the downside. What's the case here for the tariffs? We started off the show with this conversation and got a little sidetracked, but if we're giving China our fanciest GPUs that have military applications, why on earth are we moving ahead with are we really moving ahead with these tariffs against Canada, Mexico, tomatoes?
I mean, I think I don't think you are. I mean, I really don't think that you are. I mean, I know that they are, but I just don't think it'll last. I think that the tendency that I don't believe the Republican Party wants to be responsible for an economic catastrophe and be known as the biggest group of idiots since Liz Truss, which if they go through with this, they'll be known as the American Liz Truss. And I think that they know that, I mean, and even if they try to go full Liz Truss, I believe the bond market will kick in here in a much more aggressive way. And the stock market. I mean, this whole thing's going to get flipped all over itself. And then it's going to be Donald Trump yammering with Peter Navarro and Howard Lutnick. And they're not going to have many friends.
Well, Trump's been touting the stock market again. He's been touting the stock market again. And at the start of this week, first call, we were talking about the, concepts of the taco trade. Trump chickened out because the bond market got yippy. Until the bond market gets yippy, he can't chicken out. So this is literally a game of chicken of who's going to move first. Is the bond market going to freak out to get Trump to back down? Or is the market going to tell Trump, this is all fine, do what you're doing? Because that's his perception. If stock market's near all-time highs,
no problem.
No problem. And markets go up and down over time. So like the S&P, yeah, it's off here today, but
this is nothing.
If you're one of his advisors today, what are you telling the president? Mr. President, yeah, we had inflation data due out today, and NVIDIA had their chip announcement. Market's happy. NASDAQ hit a new all-time high during today's session. And that's not false, that it did happen.
Yeah.
Do you think the guy's like, oh, yeah, I should back down? No.
Well, this is the whole...
Obviously not. However...
So we have to go one turn of the barrel before...
Yeah,
taco
exactly.
Again.
We're going to have to unload one round from the chamber to get everybody's attention, just like you had to do in April.
Well, this is the whole thing, right? And I'll borrow from what I was texting Chris overnight, because I think this is sort of where my head's at now. The only thing better than the news cycle of taking a thing and essentially setting it on fire, breaking that thing, is fixing what you just broke. And then the only thing better is to break it again. Because what that does is it creates this perpetual tension and instability that then becomes the negotiating tactic itself. It creates so much volatility for everyone involved that everybody just goes, oh, the hell with this. Let's just figure out some way to mollify this for 3 years.
Which is 10% on everything. Shut up and go home. How about that?
Can we just table this nonsense for the next 3 years? Just give him what he wants. He'll be gone in 3 years, and then we'll deal with whoever is left. So you get the sense that all this is just more circus. And I think the markets are there. I think the markets get that at this point. I think the markets had the concern in April that this was more than just a circus, because it looked like for a second there with the phone board that what the U.S. is going to do is surgically extricate itself from the foundation of a financial system that it built on top of itself. Basically, like the foundation of your house decided to dig a tunnel and leave. And then everything that's on top was just like, oh, well, figure it out, buy some stilts or good luck. And
that lasted a week. That lasted a week.
It became very clear from April into now the beginning of July in the exuberant performance of the S&P that was not a real thing. That's not what the risk is. And if that's not the risk, then this is all a circus.
Can we throw in a new fun risk in there?
Yes, please.
As of today, the RFK-led Health and Human Services has announced that currently 1 in 148 Americans has COVID-19. 2.268 million cases going around.
Is that
right now? Are doing it right now.
Transmissions up 38.1% week over week.
It's a rough version of it too.
So what are you saying?
Nothing like a summer flu to lose some weight before the beach, Dylan? Are we going to go through
I
a?
like your thinking. I love silver linings, baby. I like the silver lining. You're gonna look good when you come out of the vomitorium.
There is the bull in me that's like, what can we do to get some? We've done this before. We've looked at like Novo Nordisk.
Biotech's come back. Biotech got face plastered. It has come back a touch.
I don't know. Maybe we did this. What was it, back in May when or April, when we had the bird flu going around, just in case, and it almost worked out. We had like $10 calls, and it did rally up to 9. Unfortunately, they never printed. But I don't know. What tail risks are out there right now, Elliot? I think this is the question I'm thinking of myself. And actually, Dylan, I want you to go first. What are the things that the market is treating as we're a little too complacent about?
Probably tariffs.
Probably tariffs.
Because I couldn't be more complacent. I mean, I still think the outlier risk is that the tariffs are more real than my dismissive and condescending attitude would suggest. So, I mean, but I don't think I'm the only one. I think the entire stock market has looked at tariffs like a non-factor since mid-April for all the reasons we've talked about ad nauseum. I do think I think that the risk of some sort of tariff chaos is probably underpriced. Although were the tariff chaos to emerge, I'd be a buyer.
I mean, so I think that is both right, and we need to make the distinction when we dismiss the tariffs that there's the tariff soap opera, and then there is the economic consequences. And while the soap opera is that, the economic consequences are very real. And so at some point, and maybe that's right now, because that's sort of how this was in February, the markets went, yeah, we don't care about the soap opera. We care about the economic consequences, and we don't like those. We're afraid. And then when the soap opera eats up all the air in the room, you go, yeah, but this is the soap opera. It doesn't matter. And then the data doesn't show up. It's only the soap opera you're talking about. So it's tariffs, and it's tariffs. And the one angle on it is a complete nonsense clown show. But the other side of it is a very real economic consequence.
Guys, we only have a few minutes left in the show, and I was figuring that we could throw in a little bit of a fun segment here to lighten things up at the end.
We're not having fun. I'm having fun. What's the issue?
Listen, I'm having
more fun.
Listen, sometimes you say things. I thought I was having fun last night when I was talking about the NVIDIA thing. It's like apparently the administration's plan is to give China chips and tariff our allies and not release the Epstein files. That rubbed some people the wrong way, as I learned in my direct messages.
It did?
Yeah, I'm surprised considering what some of these people's Twitter profiles said and some of the things they retweeted. They certainly give off the vibe of like F your feelings. And so I figured, a fun joke wouldn't be so terrible. But let's have some fun here at the end. What are we watching? What are we reading right now out of our free time out of work? What are we doing to stimulate our minds outside of the office? It doesn't need to be learning. It could be something complete crap. Ilya.
I have been listening to this new Clips album on loop since it came out on Friday. It is a masterpiece. It is an instant classic. If you're any fan of hip hop, go get it.
Dylan, surely you have something interesting going around in your life.
Push-ups and pull-ups, 100 a day, 100 push-ups a day, 50 pull-ups a day, and then more push-ups. I'm on a push-up and pull-up madness situation, and I find it mentally therapeutic, and I recommend it to all my friends. I suggest more push-ups, more pull-ups, and less cigarette smoking.
I'm with you. I'm up to 192 on push-ups, though not consecutively.
No, of course. But
of
no,
course.
Neither me. But I couldn't. I believe the push-up is the greatest unappreciated exercise. No equipment
100%.
Just get out of your chairs. Don't be an idiot. Get down there, do the work. It's not that hard. I might do some right now.
At night, after I put my kid to bed, I've been getting on my treadmill and putting on the Odd Lots podcast and just walking for 30 minutes. Nice. Like it's not an after dinner walk because it's dark outside, but like it's something to do. I find that actually really stimulating to just like unwind.
I think walking is probably the most underestimated thing in the world. I believe you got to walk.
Gotta walk. In fact, it's a good time because the markets are now closed, so I can go exercise. You guys can stick around for Ilya because he's here for macro money, and overtime is out of time. So for Ilya Spivak, Dylan Radigan, I've been Chris Vecchio. Good luck trading. We'll see you tomorrow. Same time, same place, as always here on Tasty Live. Keep watching. See you soon.
In the world of investing, a beast lurks between the numbers. Some watch from the safety of the sidelines, but others saddle up and ride that one-ton rowdy ribeye for all he's got. If that's you, join us on Tasty Trade, named best online broker for options trading. Genius loves company.
This is Chicago. We invented the skyscraper, the Italian beef, and the standardized options market. SIBO is not only the birthplace of options, it's also where Liz and Jenny got their start. In an industry first, two female former floor traders broadcast live from the floor. Hear the sounds of live market action and feel the electricity as they present real-time trade ideas and research-backed market studies live from the SIBO's SPX pit. Watch Liz and Jenny live from the SIBO, only on Tasty Live.
The future of trading is here. Join Mike and his whiteboard, plus the Tasty 2 live crew for 90 minutes of probabilities, punchy portfolio mechanics, and trade tactics. It's totally free and unreasonably fun. Come early to enjoy a drink with the crew and stay for a Q&A after the show. Space is limited, so register today at tastylive.com/events.
If you missed the live show, here's our cherry on top yearly recap.
Breaking news on Instagram. The first segment of your line dancing has been posted. Left together, switch, turn. Right together, twirl, turn. Hip, hip, hip.
Right together, spin, clap. Left together, spin, clap. Hitch, 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 turn, shuffle, rock, shuffle, rock, shimmies, shimmy.
I took 5 lessons for cases where all I knew what to do was
Right together, spin it around. Yeah. And you want to clap. And then like strut down, strut down, strut down, strut down. Right together, spin. Left together, spin. Hitch, 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 cross, turn, shuffle, lead, shuffle, rock, shimmy, lasso.
this is not good.
Hey! Oh, he's got the walk down. He's got it down.
It's perfect, and you got the bag. You got everything.
That is not even close.
God, bitch stole my. Oh, it's flawless.
Look, it's beautiful.
Flawless.
No.
You're walking way too fast.
And go stick your finger in all of our lunches.
Now complain about something.
Oh, God.
You watched the debate, you knew who won, and you just didn't want to admit it.
I was in New York. I was flying home that night, and I'm so sorry that I didn't go back and tape the vice presidential debate.
First of all, I think it's hilarious that you run a technology company and you still think you had to tape it in order to watch it. You think you have to tape it?
He didn't have a blank
VHS
VHS tape to spare for the debate. Stas, what comes up next? The opening bell. Don't look so surprised. Sadlov has been this way since 1980 when you first started trading. Wait a minute, was it always 8:30? Yes, the opening always was the same. The closing has changed.
Like, what has changed? I don't think so. Nothing's changed. The only thing they did, I think, was add the 15 minutes.
Excuse me?
The only thing I ever think that changed was the 15-minute curb session.
From 3 to 3:15, so they did change it. So it was the closing and not the opening that's changed.
For option traders, the 15
minutes. Well, listen. We're not being traders here.
Do not engage.
Wait a
minute. So
when I got in this business,
we used to open it. We used to open at 9 o'clock. Since
1980, the New York Stock Exchange opened up at 10 a.m. Eastern. It closed at 3:30 p.m. Eastern Time. The schedule was in place until September 1985, when the opening time was changed to 9:30 a.m. Eastern.
Pay me,
Get the full scoop by checking out the archives at tastylive.com.
Well, it finally had to happen, I suppose, and now it has. Inflation data has spooked the markets. This is Macro Money. I'm Ilya Spivak, head of Global Macro here at Tasty Live. We finally got the CPI report to unnerve investors in all of this tariff drama since the beginning of the year. We're going to break it down here and see what it was in these numbers that the markets so disliked, what it means, and what are next steps here. Of course, as ever, we've been watching this story in the context of a disconnect that's emerged between what the markets expect for Fed policy and what the Fed itself has been saying. And today, we have a very emphatic check mark in the Fed's column. And what the markets have done is they've interpreted that information as one might expect, by saying that the rate cuts are probably coming still, just later and more forcefully. So we'll see here what the market response has wrought. Here's the performance across major markets for today. The NASDAQ basically flat, but that undersells the level of weakness. It was, in fact, up at a new record high earlier, following overnight news that the Trump administration is going to let NVIDIA have a more free hand in selling to China. So the Mag 7 complex and sort of the AI constellation of stocks and tech in general had a good day. But for all of that, for all of the run-up in the NASDAQ here, we end up with a net, let's call it flat close and be somewhat generous. Because at one stage here, the NASDAQ was actually up by a meaningful amount here. From yesterday's close to today's high, we were up almost a percentage point, 0.8%, and we're closing having erased all of that rally. So quite the downswing here. The S&P for a sort of more catch-all view down almost 0.6%, yields up across the curve, 10-year up 1.2, 2-year up 1.28, oil down, gold down, the dollar up across the board, Bitcoin selling. Fairly classic kind of spooky interest rate environment kind of risk aversion across the major markets here. Gold probably the most impressive of the bunch because this 0.7% swing is quite modest compared to what you might expect in an environment where yields are up over a percent and the dollar is as strong as it is. You might have expected to see gold lose a lot more ground. It ends up swinging lower, but still well within the range that it has occupied basically since late to mid-June. So going back to sort of the overall story here, the 4-week, 3-week range in gold, 3 weeks back and then this week, it holds on this, which perhaps speaks to its resilience in the face of what is a shaky environment for risk sentiment. We get this data today, and it's basically in line with expectations at the headline, 2.7% for the headline inflation rate, just as economists had it penciled in. The core reading a little bit cooler, as a matter of fact, 2.9% versus 3% expected. One might expect this was, for the most part, good news. But when you look at the internals here, a number of things immediately stand out. It's certainly no shock that what you have is still most inflation locked up in core services. No surprise there. Core services is overwhelmingly the largest part of the U.S. economy. Most of the inflationary impetus, or frankly, disinflationary impetus, most of any kind of reflection of the economic growth to price connection should be in core services because it is the biggest part of the overall economy. The thrust for overall inflation dynamics will invariably come from this side of the ledger. But having said that, we are seeing the most significant contribution from goods that we have seen since 2021. Last time that we had something comparable like this, and it's not a lot, it's only 0.13 percentage points here of the whole. It's by no means a large contribution. So if the headline is 2.7, 2.24 of the 2.7 is services. No surprise. But the delta in the change here is much more eye-catching. Notice the headline up 0.3 percentage points. The increase from services, the contribution from services, is up just 0.02 against 0.08 for goods. So the swing in goods, the thrust in goods, is 4 times that what you see in services. And this is really the main situation here. Now, obviously, energy gets you a little bit of an uptick for reasons having to do with spiking energy prices around geopolitical risk, and that's probably a fleeting thing. But that's hardly what is the main concern here. It is this. Because what the Fed has been concerned about the entire time that they've been commenting on the implications of this new tariff regime that we've seen emerge since the beginning of the year and its implications for policy, is that the Fed doesn't know how this is going to go, but historically, you get this jump in inflation from a tariff because what a tariff basically is just a consumption tax on imports. And invariably, what it does is it makes those imports more expensive. Just tax on an extra cost. And that is something that the Fed does not want to extend out into broader inflation expectations, because then all of the progress that the Fed has painstakingly secured becomes challenged. The Fed has, through a very spirited rate hike cycle, the most spirited, one might argue, since Paul Volcker in the 80s, secured a decline in inflation from north of 9% by a hair back down sub 3. So this is not anything the Fed really wants to let out of the bag at all. It wants to keep inflation expectations anchored. And for the most part, it's been successful in doing that. But when you see this kind of a shock start to actually show up in the data like this, as an initial early step, perhaps, foreshadowing more downwind, you start to lose faith in the ability that the Federal Reserve is going to be able to cut rates with any kind of significant impetus this year. And so, indeed, as a response to this data, the calculus for the overall shifts a bit, but really the view for 2025 starts to move into territory where the markets are now less dovish than the Fed's own outlook. As of today, we're down to 39 basis points for this year, but we are out to 68 basis points for next year. In other words, what the markets are saying is that the Fed has less capacity to cut rates this year than even it has accounted for. But that what this will mean, what this delay is going to mean, is that the Fed is going to have to cut more later. In fact, notice where we are here. This setting for the 2025 Fed outlook matches us back to where we were here in mid to late February. And of course, this is where the stock sell-off began around the rollout of the tariffs as they began to spook business and consumer confidence surveys, and the markets thought this whole thing was a growth risk. Note that while stock markets have rebounded since all of that story seemed to crescendo in early April, but policy expectations have been anchored in a range. And the only thing that's changed, if you'll notice here, is there's a lot more gray here than there is yellow. In other words, the markets thought most of the peak 137 basis points in cuts here would come this year and a little bit next. That script has flipped. Now it's most of them are going to come next year because the Fed couldn't move and is right to be, frankly, dragging its feet for this year, according to what the markets now say. Compare that with what the Fed just updated for its summary of economic projections in June, and you have 50 basis points for this year, the median rate now 4.4%, so down to 3.9 is 50 basis points. That's 2 cuts. For next year, as of the latest update, the Fed slashed a cut out of the 2026 outlook because ostensibly it feels like the full tariff impact will take longer to see because of delays in the data and because, of course, the tariffs themselves have been constantly paused and variously diluted. We have another cliffhanger on the reciprocal tariff architecture coming up just next month. And so the Fed is only seeing 25 basis points next year, from 3.9 to 3.6, and then another in 2027, though that's most likely a bit far to really have accurate forecasting. So the market is at this point at 100 basis points. The Fed is at 75. That feels like not the greatest disparity. But then you consider for next year, the market is at 68 basis points, so leaning in the direction of 3 cuts. And the Fed's at 1. And what that starts to say, of course, is that what's going on here is the markets are disappointed. They wish the Fed would go sooner. They've wanted the Fed to go bigger than the Fed itself has forecast. In fact, here was that update in June. The Fed's been on the dovish side of it basically since it came out. But it thinks that there will be an inability to act this year to the extent that they'd like. And so they think there's an exchange rate between rate cuts now and later. And that exchange rate means that for every rate cut you miss this year, you're going to have to do more next year. Not just move the cut in time, but actually do more cutting, because what you'll end up with is a delay that then lets the economy become weaker, and then you have a bigger stimulative job that needs doing. With that, we have another batch of inflation data that's due tomorrow, and while the PPI index, the producer price index, is not typically the most market-moving thing in the world, this time around, we might actually get more action here. In fact, we've been seeing more action here for the past several months. Now, we can see the expectation is that the overall headline PPI will come in a little bit from 2.6 to 2.5, and the core will come in from 3 to 2.7. But where that downswing comes from is tremendously important, because one of the things that we've increasingly noticed here is that weakness in PPI has come at the price of wholesalers giving up margins, giving up essentially profits in order to insulate consumers from tariff-linked inflation. So consider what we have right here. And this, of course, is something that is back to where we were looking here in April's data. It didn't show up in May, but this right here, this major spike down in the trade services component of PPI is telling you that margins are getting squeezed for wholesalers. They recovered a little bit in May, but only a bit. Whereas this swing down right here, as we can clearly see, was the biggest one since back here in COVID times. And so what we end up with then is a situation where we have now the biggest squeeze shaping up on margins since basically recession equivalent dynamics right here. So it's telling us that the resilience we've seen in CPI up until this report really was something of a mirage, because wholesalers were eating the inflation. And while they are perhaps still eating some of it has started to show up in CPI. If you now get a PPI report that's weak, and the reason it's weak is because margins are getting squeezed once again, and perhaps further, well, then all the architecture of an inflationary scare from the tariffs is on display. And from the market's perspective, it was always about the growth implications of that scare rather than inflation expectations. We go back to how the markets performed in the first 6 months of the year. We broke this down granularly last week, but we'll revisit it here because it seems appropriate. What we saw in the first half of the year, for all of the hand-wringing and for all of the concern around what's going on in the U.S. and all the extra risk associated with the tariffs and maybe the Fed won't cut, rates fell in the first half of the year, both at the front and the back end of the curve. And that tells us two things. At the front end, it says the markets are pricing for cuts. At the back end, it says there is no credible sovereign risk, that the market continues to happily buy U.S. government debt and have faith in the U.S. sovereign as a borrower. And so it is not surprising then when we get the kind of performance that we get out of this news and out of this whole story today, we get higher yields, and the dollar strengthens, we see the dollar behave as the anti-risk haven type of creature that we've been used to, not the sell America dynamic that appeared in April around the panic linked to tariffs then. And so we get into a much more kind of classic setup here, where if the PPI data is going to reinforce this sense that there is, in fact, an inflation scare, the implication for markets will be, oh, well, that's probably the one-off, but the follow-on is the growth hit. And that's how you reconcile. We have cuts. There is no sovereign scare. But a cyclical commodity like crude oil, for all of the fire and fury in the Middle East, fell 9.2% in the first half of the year. And in fact, if you unpick the makeup of the 10-year yield here, as we've been doing, into duration risk, that is term premium, how much the markets want to get paid extra for having risk of time, and inflation risk, the break-even inflation component in 10-year yields, we find that since the beginning of the year, break-even inflation is mainly trending lower. In fact, it's been mainly trending lower since the end of last year. Whereas sovereign risk, or at least duration risk, seems to be building. And while it's not a U.S. default type of a thing, it does suggest that the markets want to get an extra compensation for time uncertainty. And what that seems to speak to in the context of this is that it isn't inflation so much that the markets are concerned about, it's growth, which is why they want these rate cuts. They're not so much looking to the concern that inflation expectations might get anchored. They're concerned that consumers will stop buying as prices go up and the economy will start to fade. Hence this exchange rate in rate cuts, where the market is not saying, oh, this data means that we don't need rate cuts because, look, the economy is so strong. No. They're saying we do need rate cuts because the economy isn't strong, but the Fed won't be in a position to deliver it, so the economy will get weaker than perhaps it needs to, and it's because inflation numbers are as they've presented themselves, which suggests then that if the PPI numbers are anything like what we've seen over recent months in their internals when they come out tomorrow, one might expect this layout to continue to hold and perhaps an even more significant risk-off sheen to appear across the major asset classes. And that is Macro Money for today. As ever, we are here right after overtime, show that I co-host with Dylan Radigan and Chris Vecchio, looking at the Wall Street close and where things may go therefrom. I am going to be back with Chris for Futures Power Hour as ever, Mondays and Fridays, though I believe we're off this Friday. I am likewise writing for the news and insights portion of tastylive.com, commenting at Ilya Spivak on former Twitter and on Blue Sky. If you're watching on YouTube, like and subscribe. Macro Money is back tomorrow. Happy trading.
The market doesn't stop. So why should you? Diversify your portfolio with stocks, options, futures, crypto, and more from Tasty Trade. Focus on the markets that matter to you. See the odds before you trade using curve analysis, IV rank, and more tools. Get industry insights that help you find your next trade right where you need it. Tasty Trade. Download today.
Your crypto needs a wallet. And crypto is better when it's tasty. You can now do more with your digital currencies with the Tasty Crypto app. We're proud to offer a self-custody wallet for Bitcoin, Ethereum, and Polygon. Transfer your digital tokens directly in-app and access thousands of tokens available only on-chain. Your wallet is your key to decentralized finance. Download the Tasty Crypto app and get started today.
We built Tasty Trade's web platform for today's traders. See it, click it, trade it. Research with fundamentals, endless forecasts, and more. Drill into data, find opportunity, and track the action with hundreds of indicators. Track your options profit and loss history over time per symbol. Note your progress and plan your tactics with a trading journal. See probabilities, max profit, and Greeks in one click. Fund your account and start trading right in the app. The tools, the data, the knowledge. See it, click it, trade it. Join the club. Tasty Trade.
Traders, start your platform. Tom Sosnoff and Tony Batista are hitting the road for their first ever live trading event, At Work by 11. It's unprecedented, unpredictable, and unlike any other financial event. Watch these masters make real trades in real time. Doors open at 8, the action starts at 9, and we'll have you back at work by 11. Sign up today at tastylive.com/events.
Global markets never sleep. Explore them with Forex, now available on Tasty Trade. Get in on over 80 Forex pairs, 24 hours a day, 5 days a week, with the Forex platform that adapts to your style and speed. FX marks the spot. Trade it on Tasty Trade.
Beat the opening bell. Get trade ideas and market insights before the open. From the creator, Tom Sosnoff, and our chief market strategist, Tom Preston. Every weekday. Sign up at tastylive.com/newsletters.
Well, he's more public in his mentality.
I'm a believer. I believe that the world is good.
And I know that the world is not good. That questioning yourself and questioning yourself in dialogue with someone you respect is both pleasant and sometimes extremely insightful and useful sometimes.
You can get up to $4,000 when you open and fund a new account with Tasty Trade. That's 4,000 buckaroos, 4,000 bills, 4 large, 4K, 4 grand. Get on the platform for traders who just want to trade. Tasty Trade. Make your move.
What is going on, everybody, and welcome back to Risk of the Week. Today's Tuesday. We're back in the studio today. Gus, we got some things to talk about, brother. But what's going on? How are we doing today?
Yeah, man, doing great. Errol's here in the studio in person. This is awesome. I can look right at you while I talk to you. I don't have to look down at the screen to feel like I'm talking to you.
I know.
Yeah, feeling good. Happy to be here. Having an okay day in the market myself. Got a little bit of a sell-off right there at the end, but a really pretty boring day overall. Yeah. As far as that's concerned, but yeah, we're here with Risk of the Week for you guys, bringing this segment back. Errol and I have both put on a position, and we'll be diving into that shortly. But anything macro you want to touch on? What?
Trading around all-time highs, I've never been a big fan of, and I feel like we're talking about all-time highs every other week now. So still trading at all-time highs, still managing. Other than that, have your eyes been on anything crypto related? Any type of crypto exposure? Any type of crypto chats over the last week or two?
I can't say they have. I've been flirting with the idea of getting like just real long, some IBIT, some leaps, something like that. Give me some crypto exposure without actually having to deal with the crypto. Be able to trade options as well is always nice. But I've been waiting for even a slight dip in Bitcoin to present itself for me to do that. Something kind of substantial. It is a cyclical asset to a degree, and it just keeps making all-time highs. And I find with crypto, but strangely not with the regular market, I do find myself in your camp where I'm afraid to trade at all-time highs. Right. And that really is a very backwards logic, and I'm aware of that because crypto makes all-time highs. I mean, much more often than the market. It's not uncommon at all, even now, for Bitcoin to have 100% year. So I don't know why I feel the need to sit on my hands so hard. But yeah, I think it's some long bit, like maybe into like 2027, like something deep.
No, I hear you. It just feels awkward. That's the way I like to describe it. It just feels awkward at all-time highs. Feels like the risk to reward isn't too much in your favor, but it's like glaringly a little bit, you might be a little bit more long biased, but just hard to pull the trigger when we're at all-time highs. So that's what we're going to get into for the day, a little bit of a risk of the week. So I'm glad we're talking about this today because there's a couple companies that I got in mind. So I put some thought into this one, Gus, and we can go ahead and just get into the slides for risk of the week now, actually. But NVIDIA, Gus, I'm feeling NVIDIA. I can't remember if I did NVIDIA for one of the first ones, but NVIDIA's at all-time highs. NVIDIA feels like it's not going away. A continued 3-month rally since the beginning of April. Before we even go any further, what are your thoughts on that rally since the beginning of April? We haven't gave back any of the gains considering we're at its highs since April 7th.
Yeah, NVIDIA is an interesting one. Meta was on this same trajectory for a little while, though I do think they've had a small pullback to kind of quell that out now. But yeah, I don't know. I go back and forth where, I mean, obviously anytime something is on a 3-month rally, I mean, what's the thing? On any time frame, it's hard to get more than 3 or 4 green candles in a row before you catch a red candle. And so if we were looking at this on the monthly time frame, we're starting to push that envelope where it does feel like it's high time for a red candle. But also, I mean, NVIDIA is the darling of the market in every sense of the word. I mean, it is the alpha and omega right now. First 4 trillion company in history, number 1 company in the world. You say AI, you think NVIDIA. They're making this big investment into their data center, I guess, development center in America to try to take a little bit of that tariff burden off themselves, which I do like. But that said, I do think every stock needs a little bit of time to breathe. And when Meta and Microsoft were also on these cataclysmic runs, right behind NVIDIA coming out of the Liberation Day sell-off, I feel a little bit more wary about that. But with both of those stocks having now taken a turn and at least had their own breathing periods, it feels like it might be time for NVIDIA as well. Yeah, no, 100%. To piggyback off of that a little bit, I mean, kind of feel this is a little bit of my personal opinion. It feels like everybody's in this NVIDIA trade right now. It feels like NVIDIA had a lot of steam to the upside over the last, year now? It feels like NVIDIA's been relevant a year and a half, maybe longer. But it feels like everyone's in that trade to all-time highs, and that contrarian in me is itching right now. And then hopefully, maybe earnings could disappoint just with all of the tariff news, all of the uncertainty. I know there's still been conversations around China and their chips and the accessibility with NVIDIA and things like that, but maybe that caused a little bit of a hiccup in their earnings, so maybe we get some negative earnings that'll help my position out if we go ahead and put that position on. And then strong dollar had one. The stronger U.S. dollars makes NVIDIA's overseas sales worth less. That's better for a company with global customers. So look for this NVIDIA pop, right? I mean, I feel like we never got that pullback in NVIDIA. It's reminiscing of that March of 2020 COVID crash that we got in the market, and we never got that significant pullback. It feels like NVIDIA went on an absolute tear, and I've been waiting on that pullback that we never got. So that's where I'm at, Gus. Yeah, to address the concerns popping up in chat, this is, you said 33 DTE is what this trade is for you?
This is, no expiration yet. We're going to go ahead and put this one on tomorrow.
Oh, you're saying, okay.
Yeah.
I got you. We're
going to get short. Short
for sure, but like what are you eyeing? What expiration are you eyeing? Are you saying short stock?
No, not short stock. Too expensive.
I agree.
I wish I could short stock. When you guys know I made it, if you see me just shorting NVIDIA all willy-nilly, 100, 200 shares, just know we made it. But no, contracts, absolutely. Was looking more on the side of, I know we got earnings after the bell August 27th. So that's something to be mindful of. But short, absolutely.
Sure, I'm with it.
Short.
And you mean short term?
Short term, 100%.
I got you.
Short and short term.
Short and short term.
Short term.
All the shorts. Short square.
Short
you guys
square.
Heard it here first.
Short square done.
All right. Yes. And that's obviously true. I don't know how long term I would ever want to be short on NVIDIA. Shorting NVIDIA is like shorting PLTR. Can be painful, but can be profitable. I think we hit the nail right on the head with that one.
Oh, yeah. It's called risk of the week for a reason.
It is.
We're putting a little bit of risk
absolutely. And I'm about to talk about a pretty freaking stupid position.
No, I like I like where you're going with this one, though.
To be quite honest. But yeah, we can jump over to next here. My risk this week is Centene Corporation, ticker CNC.
Okay.
This is one that I've mentioned on air before. I took 2 positions on this one. The first one, which I closed for a loss today, I decided I was not going to let a short put run and destroy my entire year. So I finally had to get out of my initial short put. But this is the second one that I put on. I put this position on 2 weeks ago. It's actually moved down a little bit further. You can get a better fill than I did. 345 is the current price on this contract. But they're currently under investigation for securities fraud. Get that out of the way right away. That's an issue. It's not good. It's usually not good for your company. However, companies, and especially in healthcare, as I noted here, they tend to wiggle out of these things. And, the bigger the company, the better in that regard. But in healthcare especially, there's lots of ways that people tend to find their ways out of these things, I feel like. So the initial move came on July 2nd when this news broke. It's fallen about 8% from there. That's why I lost on the first contract. But I do feel that this investigation is fully baked into the price at this point. This is a long time to expiration, so there's plenty of time for everything to work itself out, however that may happen.
Yeah.
If they're found innocent of securities fraud, then all of a sudden this thing just shoots back up and this is a massive winner and it's done. If they're found guilty, I do think that they could move down a little bit further, but it's already slid over 50% on this news. And I feel that right now the market is pricing in the guilty verdict. I feel like this is a guilty until proven innocent situation, at least the way the market is treating it. And so I don't know how much more downside there would be should this result be what everybody seems to expect at this point. Beyond that, these investigations take time, and this thing could very well drag on and on and on through the end of the year, in which case I think that this will just slowly recover, if even by a few dollars, and stay well above this 30 strike, like the most. Why did I say 157? Where did I get that number? 157 DTE. Yeah, guys, it's a 30 put. The stock is currently closed at $30 on the nose today. 157 put is a typo. Mea culpa on that one. But yes, a 30 put. So I just need this thing to stay above 30. Even if we just get back another $1 or $2 before the end of the year, that would be all I need. And I think that there's a lot of ways we could see that happen. So yeah, like Errol said, called risk of the week for a reason.
Yeah,
This one is certainly high risk, especially being short a naked put, especially against all of this bearish news. Yeah. But I'm just hoping for a no news is good news situation that we can gradually recover, if even a little bit, if even 6%, and put me in a more comfortable spot. So that one's my
contrarian risk. Gus.
Yeah,
there we go.
I try to be contrarian. So I thought CNC was something different.
CNC. I gotta say, December 19th, day after my birthday. I hope this works out to you.
How about that?
And so that'll be my birthday present to you. Is this trade right here?
you giving me a present on your birthday?
If it works out,
not how birthday presents
exactly.
work.
But I mean, 345 of credit, 157 days left till expiration. Gave yourself a lot of time. And I mean, I think that was pretty smart. Like you said, with the investigation, so much uncertainty with the investigation. Got a nice little time frame to work with.
I wanted the time horizon, and there's 2 schools of thought on this, because the other one, and it was I executed on both of these schools of thought, because my first trade was a short 3250 put that was set to expire at the end of this week. And my thought was, this is so short term. I think this all got fully baked in on the first couple of days of this news cycle, and that we will probably see at least some kind of little, recovery, like what UNH did. UNH all the way down to 270, and then it bounces back to 330 before we find a level and stabilize. I thought we would see a similar dead cat bounce with this one, and then it would all work out well with the timing. Doesn't always happen that way. The price continues to be negative. So I'm happy to still be holding this longer dated one. I stand to gain more from it anyway if it works out.
Yeah, I like it. I mean, the pop must have been pretty decent on it. I mean, 345 credit all the way out on December 19th. It had to have been decent, right?
Yeah.
What's going on?
I'm chuckling at Lone Sofo. Lone Sofo said orcas, which is just is so sharp. It is the orcas. But anyway, what was your question? I'm sorry.
No. Losing my train of thought there. No, but I like the time window on the chart. I like it. CNC risk of the week for a reason.
Yeah, should let it run. I like when I'm rooting for things to go to zero, because I find I'm pretty good at taking things to zero.
Yeah.
It's like I'm a zero man, and so I with the trading the tasty way, you can make money on things going to zero. So that's what I'm trying to do here. Whatever the opposite of Midas is. If somebody can tell me who Midas's enemy was, that would be great.
Moan might have that one for you.
But that's my risk of the week there.
No, I mean, I like it. We'll see if we can get filled on this one tomorrow on my end, but we can go ahead and jump into the platform here, do a little tour to market, see what we got on over here. You can see we were looking at NVIDIA. NVIDIA earnings is going to be after the bell, August 27th. What are your thoughts on like earnings season as a whole? As I was going through the high options volume watch list today, it's like I'm wading through potential trade opportunities, trying to walk around all these potential earnings that are next week, week after that.
Yeah, I agree. I mean, I love earnings season. I love earnings season because it, obviously because of the opportunities, but I like to kind of attack it in a different way. I'm not generally looking for good opportunities headed into earnings calls.
Right.
I want either to play overreactions to earnings calls or sector moves where there's another earnings call coming up.
Right.
So, for instance, something that I'm eyeing heavily tomorrow is United Airlines, which I wrote a wonderful article on today on tastylive.com. You guys should check it out. And I'm looking at UAL. They got this big pump because Delta Airlines had their earnings last week and they were really good. So the whole airline sector gets inflated. But now we have UAL pricing in somebody else's earnings. And to me, and it's already started to come back down a little bit, which I think is reasonable. I should have been quicker with this reaction after Delta's call. But to me, we're pricing in Delta's earnings into United already. How much better could United feasibly do? I suppose it could also pump the entire sector up if the two of the biggest players, I guess American also exists, report good numbers. But yeah, it's just very interesting. So sentiment moves like that, I like to kind of try to get contrarian and play the other side where we're acting like it was United's earnings call when it wasn't. And what could United possibly say in their earnings call to push higher highs? So I'm not 100% sure I'm going to get short on that one. I may try to find an angle, but I greatly prefer trading earnings that way as opposed to trying to trade the earnings call itself and predict.
Anything this earnings cycle you're kind of eyeing? I was debating. I was even debating on putting on an earnings trade for this risk of the week. But as we get in Chicago, I'm trying to nudge my way in there slowly. But any earnings you're personally on?
No, I like to take it week by week. And United is the one this week. I just, especially with trying to play overreactions and very often getting involved after the earnings call in the first place. I don't try to have an incredible amount of foresight.
Yeah.
And especially because anything that you're doing, anticipating earnings longer than say two weeks out, you're really getting
it's quite literally a binary.
It is. It's so binary, but also it's like, and especially in this environment with tariffs and everything and forward guidance often meaning more than revenue and EPS, they really, I don't know, it's more pronounced than ever, and their actual numbers, you can guess totally right about their numbers. You can say there's no way these estimates are right. I think they're going to beat EPS by 20% and be 100% right, but they give poor forward guidance, suddenly the stock slides. And so it's like you have to be able to be right about so many things, be able to guess how all of these variables are going to work together. Like with United, they have one thing is that jet fuel costs are getting much lower, which is obviously good for them. But something that we're going to be waiting on in their earnings call is their cost of labor. Has their cost of labor gone down? So then you have to begin to quantify how much does the cost of jet fuel work against that cost of labor? What are their actual earnings numbers even going to be in the first place?
Right.
Will either of those other factors override the actual earnings numbers? It feels like if you're trying to trade earnings, it's like a 5-team parlay, and you need all of these things to go right for your trade to really work out and pop. And I would much rather let everybody else try to price all that in and then get in after the fact and, let the panic go away and things usually work out.
You rather let the market show its hand a little bit.
Yeah, it's true. And
lack of a better phrase.
And in a more macro context too, not macroeconomic, but macro to me, I find myself being much more of a price action trader in general recently. Liking
in terms of finding your bias?
Yes, in terms of finding buys or getting short on things. Similar situations to what we were looking at with Disney. It's just when you get a strong move in one direction, especially in the age of information and instant information, the way that we have it, those moves tend to be overpronounced and they produce a lot of very attractive premium that you can take angles on. So, I would say, just price action and the overreaction.
I'm excited. We'll see what overreactions we get in the next couple of weeks with all these earnings coming up. We'll have a lot to talk about. But a little tour to market. We're short on the micro NASDAQ right now. I know we got a little bit of a pullback headed into the close. But we'll see if that continues on into tomorrow. Kind of sitting break even right there. Coin sold an out of the money call spread on coin, Bitcoin, and crypto, standing strong. So 3 days left till expiration on that one. We're gonna have to just sit that one through for the rest of this week. Then we got CRCL, Circle Internet Group. This one's playing out pretty well. Very slow mover, up just $73 on this one. It is an out of the money put spread that I sold on it. So we're getting a little bit of a rally. IV's pretty low, so I might even consider taking this one off a little early just because IV's really low. I know it's 31 days left to expiration. I could be a little bit more patient, but at the same time, I could just deploy the capital elsewhere. And then we got Disney. Disney was another one that kept going ham to the upside, even after all the news. I don't know, that dad saved his daughter on the cruise line, jumped off, and then just shot Disney to the moon, even higher.
It's true. And I'll tell you what, too. The media tried to villainize that guy.
They did try to and it wasn't
true. Even his fault. It wasn't even his fault. They're saying this man put his daughter on the rail, and it was just wrong.
How was that the narrative immediately?
I know. I mean, I think it's because, and I don't want to make accusations here, but I think that perhaps Disney pushes that story to take less liability, take some liability away from them. I think that the news says Disney.
What a
happened,
great point.
And Disney says, "Oh, this dumb dad."
What a great point. You know what? That's so funny. I would be curious to know if it was something like that. I was curious if it was just like human behavior, like you know how when you play the game Telephone. I was like, did that just like catch on really quickly because people want to have an answer as to why something happened right away? But also, could that be another reason? Could there be something deeper behind it from a business perspective and from a perspective of how large this business is, like Disney? Doesn't sound too far-fetched in my opinion.
Exactly.
Curious about that.
Well, yeah, and I mean, you shouldn't, and I mean, it's objectively true. 6-year-olds should not be able to somehow shimmy their way off of the cruise line. Yeah. So yeah, I mean, it raises lots of questions. So yeah, that's my tinfoil hat there. Is I think it's Disney doing that.
My tinfoil hat is the fact that this made Disney rally to the upside, and I happen to buy a put on Disney. So we got a little bit of time left on this one. It's going to expire here soon.
Was that your TA that the kid fell off the boat?
No, that was the fundamental. No. Okay. I was in it prior. No.
Oh, this is the one you've had open forever.
Yeah, it's been a while. I've been in that one a little bit longer than I would want to. Eli Lilly, this one has been moving a lot today. Had a big move to the downside. IV rank is propped up right now. And that worked against my position, but we were up a little bit on it. And if I wasn't up a little bit on the Eli Lilly position, I'd be down a little bit more on the overall position. And right now, both of the contracts are sitting out of the money. So I'm comfortable. I just got to be patient, give it a little bit more time. Netflix, this one's coming in clutch today a little bit. Netflix is down a little bit on the day. We had sold an out of the money call spread on Netflix. Both of these still sitting out of the money. And then we got QQQ. We got a few positions on in here. With QQQ, we had sold.
Yeah, just a few.
Yeah, just a few. I think one on in there was a test position that was just trying to route for today. But I'd sold an out of the money call spread just to indicate my longer time frame bias. I'm not a pessimistic. Okay, I'm not a pessimist. Right, I'm typically an optimist, so I'm always short on the market just because I'm naturally a contrarian, not because I'm pessimistic all the time, guys. And then I also have on this Iron Condor. I sold an out of the money put spread. Sold in was out of the money call spread, and that one's going to expire by the end of the week. So if we can get that pullback, this one can land right in the breadbasket, and we'll take that one off the table. But other than that, that's all we got over here, Gus. Nothing really too exciting, but things are moving. Anything exciting or standing out on your end?
No, I mean, I have a number of positions that are 3 DTE here. Oh yeah, I will say, I have a position on General Mills, GIS.
General Mills, GIS.
Yeah.
What's going on over there?
Yeah, so can we zoom out a little bit here? We had a nice dive on this one. How long have I had this open? 20 days. So yeah, pretty much that little micro bottom right there in the chart before. Yeah, that one, you had it. I bought right at the bottom. They had that one. Yes, they had a bad news cycle. Grabbed it there, and this will at the time was an out of the money call spread put spread. I sold the 50, bought the 47.50.
Okay.
So just needed this to move back above 50. I was expecting a bounce off the bottom, like I just said. I like to trade overreactions to bad news, and they got bad news, and it came down. And so I was like, okay, cool. I think we're going to bounce. I think this presents a very interesting opportunity. Got short the puts immediately. It did bounce. For 4 days, I was like, I'm the greatest trader in the world, and there's no chance that this doesn't get home. And then eventually, things started to turn over just a little bit, and right now we are just pretty much right at the money. Closed 49.99 today. Needed over 50 by Friday, so that's certainly what's stressing me out the most this week. Though I do think that'll get home, and we just need a couple more solid days in the market here. But other than that, yeah, I mean, I've just kind of been taking some winners recently. Honestly, I got longer some Qualcomm earlier this week. I have all types of things. I have an August 15th, 31 DTE this year, 170, and I have to say this year for reasons I'll get into. An August 15th, 170 call, which is bleeding. I also have a short 130 put for October 17th, which I picked up. That's one of the ones, the additions that I made this week. We had suddenly gotten close enough to 130. 130 would be like a 5-year low. I don't know if it's 5-year low, 2 or 3 year low for this stock. I think there's no way we see 130, but suddenly there was some premiums on those contracts with this downside move. So I grabbed one of those, and I also have a 250 call, January 18th, 26, 250 call, 338 DTE, June 18th. I can read. June 18th of next year, June 18th, 26, pretty much 1 year to expiration, 250 call. That's more of a gamma play, hoping that maybe sometime some good news will break for Qualcomm and they get some kind of 8% move in a day and suddenly those premiums will fly through the roof. I don't know that that's realistic that could ever get in the money. I think that's one that I should be able to liquidate sometime before then profitably. But yeah. Oh, and I got long some bonds. Nice little boring bond trade. I know. So
I was getting too risky. I had to go with the bonds.
Yeah, right. Had to cool it a little bit. But yeah, bonds, that's a January 16th, 26, 185 DTE, 85 call. Bought it in the money. They've come down a little bit more since, but I just didn't really want to be dealing with theta in any capacity.
Yeah.
Again here, just thinking that a rate cut will come sometime before the end of the year is pretty much the entire line of logic behind this trade, and everything would work out from there. But yeah, that's all my new additions. And yeah, still got plenty of stuff open. Still holding my Surf Air from last week. And I'll tell you an interesting one is I got leaps also June 18th, 26 on Starbucks.
Okay.
Something that I like. I like this Brian Nickel. I think he's going to do good things for the company. Former Chipotle CEO. He obviously took them to cataclysmic heights. They had to split and things. And I just really like everything that he's doing with Starbucks right now. I really like this Back to Coffee initiative. Have you seen that? That's like his whole thing.
The Back to Coffee initiative?
Yeah. It's like his whole thing is he basically just walked into Starbucks and said, we're going to chill out. And he cut like 20 drinks off the menu. And he really wants Starbucks to just be about coffee and less about trying to be trendy. He wants, to try to steal the market share back from people who maybe abandon it because it got too expensive or whatever. And then another thing that I really like is he's really pushing what he calls the 4-minute rule. Wants every single drink made in 4 minutes or less. He's implementing all kinds of infrastructure, including some AI, to try to facilitate that. But I just think that both of those are very strong directions to take the company, and I like his funny words. So I'm jumping in on that. On those.
I would agree. You know what? It's kind of funny that they may be taking that approach, just because it kind of feels like coffee was headed in the direction of like ultimate you can customize your drink to the farthest extent. Have you heard of Dutch Bros?
Yes.
So Dutch Bros is really popular in Colorado.
I was going to bring up Seven.
Is it popular in?
I was going to bring up Seven Brew if you're familiar.
I've never heard of Seven Brew.
Yeah, Seven Brew, essentially the same thing. You know Swig?
I don't know Swig, no.
Swig is a soda place that's doing that. Started in Utah.
I think I've heard of Swig.
They don't care for alcohol or soda or coffee in Utah. So Swig, it's a soda mixing place, but it's the same concept. And then yeah, Seven Brew has also popped up. But yes, go on. I understand what you're about to get into.
No, I was just which part were we going to get into again?
You were saying where coffee was moving towards like full customization.
Oh right, absolutely. And I noticed other brands like Dutch Bros, Seven Brew,
number 7,
right? Number 7 Brew. I think Seven Brew, those type of brands were getting super popular, and it just seemed like Starbucks started to kind of dilute their own stock a little bit by kind of blending in with the rest of everybody. So,
did somebody just mention Lucan Coffee?
Lucan Coffee.
Do my eyes deceive me?
Is that like a Texas-based brand?
No, Lucan Coffee. They had a massive scandal during COVID. Like totally cooked their books.
How do you get a scandal and you're in the coffee business?
They fabricated like $300 million of revenue or something.
They're doing
of coffee, like. They traded. It's a Chinese company, like primarily in China, but they traded on the American stock market. I remember that it was like a darling during COVID, and it was popping, and then suddenly it was like they fabricated $300 million in revenue, and it didn't go away. It just got pulled off the American market, but it's still incredibly prominent in China. But yeah, BA and chat, if you could elaborate on that, I'm pretty sure that's Lucan Coffee's ticker, or it was. If we know, are they coming? Do we know anything about Lucan Coffee? Enlighten me. Did Starbucks sell their China portion? I don't know about that. Yeah, $5 to $50, then accounting fraud, then end of the stock. That's correct.
Then end of the stock.
And yes, they're coming from China, apparently. I didn't know they were opening Lucans in the United States. I can't believe the SEC is letting that slide, to be honest. Tim Horton is the best coffee. Everybody give your coffee takes. Let's hear your coffee takes in the chat. Drive by once a week. Yes, Mike, to your point about Dutch Bros, and I don't know if you had this experience as well, always line to the street.
Always. Great customer service.
Yes.
I feel everybody may have had that experience.
Yes, excellent. Right. But
you know what's funny about their customer service is they try to be so personable with you right off the bat, and I think that's an interesting route that they take.
Yeah, I mean it's sort of the Chick-fil-A approach as well. But yeah, Lucan just opened 2 new shops in New York. How about that?
Hey, lastly, in terms of changing initiatives, What was it? Seafood boils.
Oh, Red Lobster.
Red Lobster. What are your thoughts on that? You think that was a smart approach?
I like it. Yeah, I like it. I think that Red Lobster had lost their place, and I mean the endless shrimp was what sunk them.
Yeah.
But I think that what happened with Red Lobster is that they began to try to elevate a little bit beyond what their actual market was. Red Lobster is seafood Texas Roadhouse,
right?
And you must treat it as
stay
such
within your bounds.
Yeah, I think they started to get a little bit too big for their britches. Then they overcorrected with the endless shrimp, which just about bankrupted the company, which is hilarious. But yeah, no, I like this new direction. I think, and I mean, I'm a Red Lobster proponent. Those Cheddar Bay biscuits, man, that's good stuff. I'd like to see them come back around. And yeah, I think that this is the right angle. It's got people talking about them on social media again. People are wanting to get out there for that seafood boil. It looks like pretty good food. I would give it a try. So yeah, I'm a fan. Are they still public or did they delist?
I forget. I just know they were the talk of the town for a little while. I think it's interesting how both companies in a way are trying to go back to their way back to their roots. It's funny that these companies got super successful. Now they're like, what did we do right initially that got us here?
Yeah, and I think that that's a great point. And especially in the case of both, but Starbucks in particular, like you said, all these competitors have entered the market to do the customization thing.
Right.
I would also throw Dunkin' into this.
Good one.
Into this hat as well. And so when suddenly because that kind of was their selling point, was the customization was, it was always like a 2000s meme, your double frap, double whip, whatever. I could probably still recite my dad's Starbucks order, even though he hasn't been there in some years now. But it was that was their thing. But when your niche has now been infiltrated, there's these other competitors who are able to do it, and with less infrastructure, mind you. Most Dutch Bros do not have a sit inside location.
Yeah, no, they have
it's like a drive-through freestanding building. Yes, it's literally
not even
the
size of a garage.
Yes, and Seven Brew is the same way. I mean, the Seven Brew literally was like the size of a shed, and there's like 3 people.
You think there's some psychology at play there with such a small place? It makes you think it's going to be quicker, even if you're sitting in a line.
Perhaps. I've never thought about it from that angle. I've always thought about maybe it seems like it's more mom and pop or something.
Agreed.
Like,
do you think mom and pop could insinuate or also communicate this might be quicker?
Perhaps. I think it definitely communicates this is going to be more personal.
Yeah. Or maybe
and which in the case of Dutch Bro is kind of part of the angle.
Good point.
But when there's competitors popping up doing exactly what you do, and they're able to do it with less infrastructure and sell their drinks for cheaper as well.
I mean, that's the whole game.
Yeah, that's it. That's it. Yeah, they figured it out. And Starbucks, I'll tell you what, their customer service sure as shit can't hang with somebody.
Not at all, but they do. Branding is king, and they definitely have the coffee branding.
Well, yeah, and there's Starbucks. Starbucks does the whole thing where they spell people's names wrong on purpose too.
Oh,
like you've seen that?
That was wrong on purpose.
Yeah, it's like that's a thing. Is Starbucks will?
Or is that another marketing ploy spin? That we've been doing that. On purpose.
We're
human mistakes are a must.
That's true.
Happen.
Yeah, maybe it is. Maybe it is just some triple reverse psychology. I had never thought about that.
Triple reverse. Wow.
But I do think that's interesting. And I actually just saw like yesterday, a girl that I went to high school with posted a picture of a Starbucks drink on her Instagram story and was like, "Oh, look, they spelled my name wrong." I was like, "You're a cog in the machine."
You're over here standing outside. You're outside of the matrix, just like
literally. So-called free thinkers when Starbucks spells their name wrong.
You chose that latte. No. Anything else to add before we hop on out of here?
No, I don't have anything. Oh, let me read through some of these coffee opinions real quick. Yeah. I asked for them. What else we got? DRI. Oh yeah, Darden for Red Lobster. They got ruined by all you can eat shrimp. Absolutely.
I don't know how that ruins it, man. If I would have heard that, I would have been knocking on the door.
They were selling it at a loss. was the problem. Bro. They were like, we're going to loss lead with this. And then everyone just came in and shrimped until they were sick. And then they weren't making any money anywhere else. But oh man. Okay.
Sounds fire.
I'm not seeing any other thought. Maybe Dunkin' Cold Brew, Pete's Muffins, Pete's Coffee. I haven't thought about Pete's Coffee in some times. Keen's Coffee, only 2 locations. Good pull, Mike. I like the local places coming out. But yeah, I guess Lucan Coffee making a run on America. Everybody watch out. Do not buy that.
Report it here first.
Yes. If Lucan Coffee goes public again, everybody tell a trusted adult because we are in serious banana times. That's funny. Barnes and Noble. Yeah, Barnes and Noble with the Starbucks. That's kind of a vibe too. I don't know.
It is 100%.
Yeah.
No doubt. Barnes and Noble, great Great date spot, I gotta say.
It is. Yeah. For real. I would meet. I used to meet my ACT tutor at a Barnes and Noble. At Starbucks at a Barnes and Noble.
Yeah.
Made a 35 on that thing too. So shout out to her. If anybody needs ACT tutors, get at me. I got a wreck.
35. You got a 35 on the ACT?
I did. Yeah. I was always really good at standardized testing. That's a thing. Like
that's a great score. No, we are running out of time here, guys. But that is going to wrap it up today for Risk of the Week. We'll see how CNC plays out. We'll see how NVIDIA plays out. It's going to be the new Risk. We'll be back here Thursday. And that's going to do it for Gus and East. Be sure to stay tuned for more segments coming on next. We'll see you guys next time. Peace.